as we approach a buyer's market, remember that lower demand is not just from buyers holding off because they feel prices will drop, but also from those who are forced to back out because they can't afford to buy it anymore. The latter part typically happens when buyers get their offers accepted at the peak, then appraisals come in lower than expected before closing, and we're hearing this start to happen again. In many of these cases, buyers end up not being able to close on their properties because they either don't have enough capital or they can't secure financing because their property just isn't worth as much as they bought it for. And this will cause a quicker downward spiral to motivate fearful sellers to sell more quickly with bigger discounts in order to actually close on their sale. Note that even though this is definitely possible in all markets as prices head south, we're not seeing this in our clients' freehold purchases in Toronto so far, and our mortgage agents are telling us a similar thing from their experience as well. Right now, properties at the highest risk are those that saw the biggest swings upwards when interest rates dropped and now have to adjust back downwards for the overshoot as interest rates hike pretty aggressively. So in this video, let's dive into this to see what specific real estate markets in the GTA are at the highest risk and then which markets might see the best risk-adjusted returns moving forward. Before I continue, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so that you can see more videos like this made specifically for real estate investors in Toronto. When we dug into where specifically our mortgage contacts see the biggest issues with appraisals, their answer was simple: the burbs. So let's take a look at price fluctuations during the last full real estate cycle from 2015 to 2020 in the GTA. Once we look at this, it becomes pretty clear that the GTA did see the biggest standard deviations, which is an indicator of how much a market fluctuates. In the GTA, most properties are detached homes and they saw a standard deviation of 0.095. Out of the whole GTA, it was the market with the highest price swings, even more than detached homes in Toronto, which also saw a pretty high standard deviation of 0.09. The main reason for higher price swings is that these markets tend to have more end users who typically buy with more emotions rather than logic. This is the main reason why so many people end up buying at market tops and sell at market bottoms. And I recently came across some back of the napkin sketches done by finance blogger Carl Richards, who illustrates what you should not do pretty nicely here. Now, as we move further from end user markets and add more investors to the mix, you'll notice much lower market volatility in investor-centric properties like condos or even the less volatile semi-detached homes, which makes the safest investments in our current rising interest rate environment. In my past videos, you might have heard me say that higher price fluctuations in real estate nowadays mean that there are deals to be had. But I actually wanted to be clear that you still have to be smart about it. Not all markets are the same, and I'm not saying you should invest in those markets that are typically more volatile. In fact, in times like this, it becomes increasingly important to invest in stable markets. The thing is, even in more stable markets, there are short periods where there are spikes in volatility, and this usually happens in the beginning when things start to change. So what I mean is that when you catch these short-term volatility spikes, that's when you'll get a better chance to pick up great deals before the market stabilizes again. Besides choosing opportunities with lower volatility, at the end of the day, returns still matter most. So let's take a look at that next. It turns out there is an inverse relationship between market volatility and how much prices move when interest rates head north. Once you dive into historical data, you'll find that markets with the lowest price fluctuations are usually the ones that perform better with rate hikes. In the last cycle, 416 condos saw the best annual returns, followed by 416 semis, then detached homes, and then the 905. Now, that's what happened in the last cycle, and it could definitely give us general trends to look out for. But of course, there are differences this time around, and these varying factors are what it takes to change things up. I think the biggest difference today is that our governments are really focusing their housing supply growth on affordable units, which condos are not. So if we expect them to follow through with their direction, then Toronto condos might continue to be hit with higher development fees, which end up getting passed on to the purchaser and end up reducing condo profit margins. On the other hand, individual investors who take on the task of creating more affordable housing units in freeholds might end up getting more incentives, which could lower their capital requirements or increase their profit margins. And then we have rent yields. It's pretty well known that houses have better rent yields compared to condos, but what you might not know is that this rent yield gap is expected to widen. In the last cycle, it was still possible to find condos that could cash flow neutral or even slightly positive. But in today's market, all condo purchases nowadays are cash flowing negative. So from a holding power standpoint, condos are just a lot less attractive compared to before, and this rent yield gap is just expected to continue to widen as there are more active ways to bump up rent yields on the freehold side nowadays if you take on secondary suite builds or even laneway suite or garden suite builds in the backyard. So from a holding power standpoint, there's just a lot more drive to invest in houses nowadays. Now, if you look just at returns, condos did the best from the last cycle. From a stability standpoint, semis had the lowest risk. And then if you look at the complete picture by taking into account returns and risk, semis in the 416 actually had the best risk-adjusted returns. This time around, after simply looking at investor preferences from our end and everything else that's going better for houses in Toronto, I'd say semis might have a good chance to do better this time around, and that will make an even stronger case for investing in freeholds in Toronto. We're big believers in investing in freehold houses in Toronto, and if you want to chat more about this, we're ready for you. We can take a look at your requirements and your preferences and then match you up with the best investment property that fits your needs. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate and investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.